Hello, everyone, and welcome to Cohen Investment Group's 2024 Mid-Year Review. My name is Stephen Heatherly, Vice President of Investor Relations, and I'm here with our President, Hugh Cohen. Hugh, how are we doing today?
I'm great. How are you?
I'm doing pretty well. So before we start, most people watching, they know who you are. But for those who don't, can you give a brief overview of who you are and what Cohen Investment Group does?
Cohen Investment Group is a privately held real estate investment firm that was formed in 2013 right here in Virginia. I've been in the real estate business for over 25 years. Our C-suite collectively has over 100 years of experience. Our firm historically has been agnostic in the products that we've owned and operated, from self-storage to office flex, multifamily, in-line retail. And we've really stayed focused in multifamily and self-storage in the mid-Atlantic, but we've branched out now to the southeastern United States, southwestern, and also mountain range. One thing I'm very proud of is our historical track record. We have a net 28% IRR to our investors with almost a 2% net return on equity multiple as well.
So we've got a lot of great topics to cover today. First, we'll go through the first half of 2024 and what's been happening in the commercial real estate market, and then go into the multifamily and self-storage sectors. Next, we'll talk about how Cohen Investment Group has been evolving in the current environment. And lastly, I hope you brought it, I'll ask you to pull out your crystal ball and tell us what to expect for the rest of 2024 and into 2025.
Great. Sounds like a plan.
So viewers are going to be hit with a lot of information today. What's that one message you want them to take away?
One takeaway is that we are in a restrictive interest rate environment. And because of that, it's been restricted for the first half of the year for refinancing, acquisitions, and dispositions. Transaction volume is the slowest it's been in years.
Looking at the first half of 2024, what would you say are the 3 to 4 main drivers affecting the commercial real estate market?
Well, it goes back to that last comment.
Yeah.
Restrictive lending environment, higher interest rates. We've heard this higher for longer from the Fed. Market uncertainty. So you don't want to buy into a market where you think that values might be declining. And so debt maturities has been also impactful. Yeah. So if you have to sell, you might be selling at more of a distressed level. And then also tenant retention and new tenant procurement.
Yeah. All right, let's tackle the 800-pound gorilla in the room first. Interest rates.
I would say the federal funds rate effectively has held, at the current 5.33% for the last several months. And it's one of the longest periods of time, as long as I can remember, frankly. And it goes back to 06 and 07 when it hovered around 5.25 as well. When you were able to buy with interest rates at a much lower level, it inflated values, and now it's the reverse effect. Yeah. So people are trying to hold levels higher for longer on their asset. That's posing a challenge, both for privately held sponsors like ourselves to REITs.
One of the other headlines that you mentioned was market uncertainty. Can you expand on that?
You have a wave of debt maturities and what's coming due, which will impact the values. Second, if interest rates do drop, and they should, as they do historically, they go up and down based on what the Fed does. If they go down, that has a positive effect on values. So if interest rates are higher and rates are going to drop, you're better off waiting to sell if you can, but some people can't. Right. And then also, a large amount of people have just been sitting on the sidelines, just kind of waiting to see what's going to happen.
Switching gears, can you talk about the expected wave of debt maturities?
So this year alone, according to CoStar, you've got about $929 billion of debt coming due. And then between 2025 and 26, you've got another $1 trillion coming due. So the question is, how will those lenders refinance those assets? How will they view the value of those assets? And that impacts returns.
That's pretty incredible. How have you seen that impact the market this far?
The bottom line is that if you're selling assets today, you're probably being forced to sell an asset. You have that debt maturity coming due, unless you have a really low cost basis. So low cost basis, hopefully that property's inflated in value, no matter what the interest rate environment looks like. And then you might just say, I'm taking chips off the table and just want to sell. So for us, we're not selling unless we have to, or refinancing unless we have to. And then also one thing is interest rates, or cap rates, were 4% 2-3 years ago, and now they're at 6.5 on average. And that's impacting the values as well. Let's
move away from interest rates and talk about investment activity. How has investment activity been in the first half of 2024?
This has probably been one of our slowest years ever that I can remember, even from starting the company. And that's not just for us talking about it, but other sponsors and REITs as well. Volume is down significantly. The bid-ask spread between the buyer and the seller also is impacting activity. So you've got sellers, I think the value of their assets are still at a 4 cap when they're really at a 6 cap. Yeah. And then asset values are still adjusting to the market. So it's more of a wait-and-see approach.
Turning our focus to the multifamily sector, what has this asset class looked like for 2024?
Operating costs have remained relatively high, which continue to impact property and performance. The national rent growth for apartments is flattening out, actually declining in a lot of larger markets, mainly due to the new supply coming to market. And vacancy is ticking up around 6% across the nation, which is the highest national vacancy has been since 2013, according to RealPage. That being said, the market fundamentals for apartments still remain strong. People need a place to live, right? And the monthly cost to rent versus get a home today and with a mortgage still favors the renter in the current environment. Delinquency rates are improving, and also evictions have been ticking up as well. During COVID, 2020, 2021, it was very hard to get someone out of their apartment who wasn't paying rent. Understand the conditions, but that's the facts. And municipalities are cracking down on bad actors now, particularly Georgia, for example, where they just recently passed the Safe at Home Act for housing, which helped recoup bad debt for non-performing tenants.
So before we started putting this presentation together, we sent out a survey to our clients, asking them what they felt about the current environment of the commercial real estate market. One of those questions was tailored towards if new construction is affecting the current value of properties.
So there are several asset classes within an asset type. There's Class A, which is new build typically, or newer build. Class B, Class C, and distress. New build typically impacts Class A first and B secondly because it caters to a higher demographic. But at the same time, Class A has not been our forte. In good times, there is this what is called a flight to quality where you might see a tenant move from a Class B asset to a Class A. However, it's my belief that inflation has put a hindrance on that upward movement and, in fact, reverse course, where you may have affordability factor, where you see a Class A tenant dropping from a Class A to a B, like I just referenced. I've always said, though, in good times, B and C stay full, and in bad times, people drop out of A into B, C product, typically. So since our firm's inception, we've typically not played in that Class A core asset type. We've been more of a Class B value add, core plus, which has had a less of a hindrance on what we buy and where.
Yeah. So, no, that's great stuff. Great insight about multifamily. So let's move away from multifamily. We're going to pivot towards self-storage. Where do you see the current state of self-storage, and what are the main drivers affecting it?
I would say the street rates, monthly rates offered to new customers has been declining. Occupancy levels have dipped. A lot of that has been based on what the REITs have been doing, which I'll touch on in a second. Self-storage is a three-legged stool. I mean, it's tied to new construction, job relocation, home sales. If new homes aren't being built, if existing home sales are down, if people aren't relocating, that has a negative influence on self-storage historically. What we've seen is larger REITs dropping their asking rates significantly to boost occupancy, almost a bait and switch tactic where a customer may come in at a lower rate for a few months and after a while, they'll jack their price up, hoping customers will see it and just leave it and forget it. Frankly, it's a dangerous game, depending on which state you're from. I think you're going to start seeing some legislation cracking down on that. It's another form of rent control, but I think it's coming.
Since the 2008 financial crisis, this asset class has attracted significant interest and new supply to meet demand. Is self-storage still an attractive investment?
A significant difference in self-storage compared to other product types is that self-storage facilities have the ability to adjust rental rates quickly, on the fly, literally in an hour or a minute. And that's given it flexibility. So with that pricing flexibility, it allows owners to quickly adjust rental rates to reflect the current market conditions. And because of this, owners can preserve revenue streams and hedge against inflationary pressures.
As I was scanning through different articles, I came across an article from Rent Cafe recently that indicated that deliveries for self-storage facilities in the U.S. are expected to rise in 2024 to its highest level since 2020. Why do you think that is?
Storage development takes a long time to come to fruition, from site identification to survey planning, approvals, whether it's by lenders or municipalities, to actual construction. The entire process can take at least 2 to 4 years. And that's why they're expecting to see a large delivery of self-storage, because a lot of those deals were identified in 2020 or into 2020 and 2021, even prior to. And so it has that timeline. It takes a while to get it built, and then once it's been delivered, and it takes time to absorb. And that absorption comes from other properties.
All right, now that we've laid the groundwork on where the commercial real estate market is today, let's go into how Cohen Investment Group is evolving in the current environment. The first question that I have for you is, how has the increase in competition amongst buyers impacted Cohen Investment Group's acquisitions and dispositions?
To an extent it has, but we've stayed disciplined. We have certain criteria and benchmarks as owners and principals that we try to adhere to. And if we have opportunities that we don't adhere to our standards, then we're not buying and selling.
Regarding self-storage and the increase in new supply expected in 2024, do you see the additional competition impacting Cohen Investment Group's current self-storage portfolio?
Not really, as most of the product type that we own and manage is value add and core plus. It's an older generation product. The newer build that's coming out or online is likely fully climate controlled, it's fully conditioned, and it also has top of market rents. So that's restrictive in some regards too, because it's going to cater towards a more discretionary spender. And then we've historically stayed away from this as we look at assets that are below value. So we're trying to create value.
Right.
Bring somebody's, if they give me $100, hope I can return $120. So that way we can come in, increase NOI and the building and physical value, whether that's new roofs, security gates, fencing, cameras, whatever it may be to improve the asset, items that make it more attractive on disposition.
What is Cohen Investment Group's goal for acquisitions and dispositions for the next 12 to 18 months?
We always put a target on our acquisitions at the beginning of a year through our executive planning process. At the end of 2023, our goal for 2024 was to do over $100 million in acquisitions. We thought it was a realistic goal. In 2024, due to a lot of forecasting from the Fed, creating volatility in the marketplace that has not delivered more activity in terms of listings, that's not occurred. So for dispositions, it depends on the debt. It's a planned exit strategy and our cost basis in a deal along with rent lift and NOI growth. Our exit target has historically been above 15%. So if it's not hitting 15% when we're looking at exiting, I'm trying not to. This, however, has not deterred us from underwriting deals and trying to create value for ourselves and our investors. There is less competition right now because of more restrictive lending practices, whether it's CMBS or agency. Agency is taking longer to get deals done across the finish line. We just completed one recently in the Nashville market that you're aware of. It took probably 15 to 20 days longer than expected. Not from us, but from the lender saying they need more time. So historically, you could do a deal in 30 days of due diligence and close shortly thereafter, maybe within 10 to 15 days thereafter. That's having some challenges. So lenders now may need 30 to 45 days to get deals done after due diligence has expired, which is causing frustration among sellers. Lenders are advising us now that they need at least 45 days after DD expires to get deals done, which is causing a lot of frustration among sellers because they want to get due diligence done and close quickly.
Another question that came in from our survey was centered around if Cohen Investment Group expects to see owners holding properties for longer periods of time due to the current interest rate environment. What are your thoughts on that?
I do believe that, yes. However, there are different forms of financing that are pushing people to sell, and that's tied to short-term debt, such as bridge loans, and which was very customary in 2020, 2021, and 2022. Now it's prevalent today because it's more restrictive in terms of what the interest rate is. If we bought an asset in the last few years and had long-term fixed-rate debt on that property, especially if the property's performing. So, but it may not be conducive to list a property right now if you don't have to.
Recently, the firm has tailored investments towards multifamily and self-storage. Are there other asset classes that you're looking at?
Absolutely. I mean, as I mentioned before, we've been agnostic. So we'll go sometimes where the opportunity leads us. We've always stayed away from those single tenant medical office based on the cost of renewing tenants in that category. Hospitality is not really our foray, and nor is land banking. But we still love multifamily and self-storage. Historically, they're the two safest asset classes. We also like office flex, though. There's a lot of stability in office flex as long as you have tenant diversification and a staggered rent roll, as it's called. And sometimes we look at inline retail as well.
Not to dive too much into politics, but we are heading into an election year. What impact may this have on the commercial real estate market?
Well, without sounding political, if there is a change in the administration and Trump gets back in office, there's a lot of chatter going on behind the scenes that he will apply pressure to have the Fed lower interest rates. I think they work autonomously, and that'll be challenging. But there are right now both banks, whether it's CMBS, regional banks, government-issued debt, they're very defensive. There's a lot of scrutiny going on deals, much more prevalent than ever before. So with billions of dollars of debt to be refinanced, unless interest rates drop, borrowers will need to bring money to the table, which is problematic for a lot of them. So values right now are looking to reset this year, next year, 26. I think more based on what people think where defaults might occur, which is going to be a problem for banks because they don't want to lose money. And then lastly, but we all know the Fed is working autonomously, right? And they have a mandate. Their mandate is to get inflation down to 2% and keep unemployment low as well. The good thing for our business is that there has been a tick up in unemployment and a tick down in inflation, which is a good sign or a good path forward for the Fed to start loosening or being less restrictive and dropping interest rates.
So looking at technology and AI, what means, if any, is Cohen Investment Group implementing for property evaluations or for our current portfolio?
Well, one enhancement that we put forth on most of our self-storage facilities primarily is keyless entry technology, also remote technology, where you can go in, you can lease a unit on your phone. You can scan a QR code, go to a call center, talk to a live body on your phone, not have to be a managed asset. That lowers operating costs, which is good. I also expect AI to play a much more crucial role in evaluating opportunities, acquisitions, dispositions, and even asset management. And then lastly, we may be able to boost our productivity with AI interfacing with brokers, sellers, equity more than ever before because of this automated service. However, we still have that human touch.
All right, Hugh, this has been great. My last question for you. Why should someone who's looking to invest into real estate consider Cohen Investment Group?
I would say several things. First and foremost, I'm very proud of our track record. We have returned a tremendous amount of money back to our investors in our tenure. We have over 100 years of experience in our C-suite. We hire the best third-party property managers we can find, and we hold them accountable. And if they're not doing the job, we find somebody else that will do it. And then the benefits of investing in real estate is twofold. One, it's a great way of creating income with passive losses, and it's a great inflationary hedge without the volatility that you see in the stock market. And it creates diversity in someone's portfolio. One thing I like to say is you can't control the wind, but you can adjust your sails.
I like that. I like that a lot. Thank you, Hugh, and thank you to those who are watching. We're going to put out more materials like this in the future, so please stay tuned. Thank you. Thanks again.